90% of retail investors lose money because their process relies on guessing. They wait for a perfect bottom, buy during peak media euphoria, and panic sell the moment a support level breaks. Professional investors approach the market differently. They do not try to guess what the price will do tomorrow. Instead, they build systems to respond to whatever the market decides to do. By the end of this video, you will have constructed your own physical Bitcoin investment playbook using the same analytical frameworks used by sophisticated funds. To start, open a blank spreadsheet or grab a notebook. Write down the total amount of capital you have available to invest. Shifting your focus from watching the price to following a playbook removes emotion from the equation. A process rooted in math and rules makes market survival a predictable outcome. Predicting if the market will go up or down on any given day is a fallacy. Since you cannot control the market's direction, your priority is predefining your response to its movement. Create 3 columns: bull, sideways, and bear. In bull or sideways, continue your dollar cost averaging, avoid overtrading, and ignore sudden price spikes. In a bear scenario, deploy cash systematically in 5 measured stages, ignoring negative headlines. Writing these rules before the price moves reduces the market to a simple multiple-choice question. The market selects the scenario, and you execute the pre-written operating procedure. Having an operating procedure is the first step, but you also need execution rules. A drop in price is only a signal once it is verified by a multi-layered filtering system. Check macro and liquidity for weakening DXY, pausing rates, and expanding M2. Next, confirm technicals. Look for Wyckoff accumulation, higher lows, and decreasing exchange reserves. Only execute if 3 of these 5 layers provide a confirmed positive signal. This checklist acts as a defensive shield against dead cat bounces. It ensures you deploy capital only when probabilities are backed by macro conditions and on-chain behavior. Going all in too early leaves you trapped. Averaging down blindly can quickly exhaust your capital before a market reaches its actual bottom. Split your capital, 60% to standard dollar cost averaging and 40% to a dedicated cash reserve. The DCA bucket handles steady, fixed schedule purchases. The cash reserve is deployed only during crashes, through layered buying hard-capped at 5 stages. Following this systematic structure allows you to ignore the volatility that triggers panic in other investors. You simply wait for the market to hit the limit orders you have already placed at descending price levels. A cash reserve provides the flexibility to buy when the market liquidates in fear. It ensures you have the necessary buying power to accumulate assets when they are priced at a significant discount. A system only functions if it is audited. Checking the price daily is a reactive habit that leads to emotional decisions. You need a disciplined audit schedule. Monthly, audit your discipline, verify your DCA and cash reserves. Quarterly, reevaluate macro triggers like DXY and M2 to see if your thesis shifted. Every 6 months, audit your risk profile and rebalance your portfolio. Evaluating your process on a fixed schedule, rather than reacting to your portfolio's value on a whim, is the same systematic approach used to manage large-scale capital. This framework provides you with the components of a professional strategy: a 3-scenario SOP, a data-driven checklist with specific macro and on-chain triggers, and a dual-bucket capital allocation plan. The market will test this system with extreme volatility. But by using predefined metrics, the guesswork is completely removed from your decision-making. Your final instructions: fund your account, execute your first scheduled DCA step, and then close the chart. Consistent returns are the result of out-disciplining the impulse to react to volatility. Let the playbook do the work.